In this video, we will explore the distinction between futures and options contracts. To start, you can think of these as two different ways to handle risk in the market. Options provide what we call asymmetric risk exposure, meaning your potential for gain looks very different from your potential for loss. On the other hand, futures have symmetric risk exposure where the ups and downs are balanced on both sides. Let us look at how this works for someone buying a call option. Imagine you buy an option and the stock price is at 60, which is our strike price. If the stock price falls to 30, your loss is limited to the small amount you paid to buy the option, which in this chart is a loss of 10. But if the stock price rises to 100 or even 140, your profit grows larger and larger in proportion to that rise. This creates that asymmetric shape where your downside is capped, but your upside can keep growing. Now, compare that to a futures contract. In a futures contract, the payoff is a straight line which represents symmetric risk. This means for every single unit, the asset price moves up, you get an equal gain. However, for every single unit, the asset price moves down, you face an equal loss. There is no floor to protect you like there is with an option. So the gains and losses carry the same weight. A key concept you need to understand in these markets is leverage. Leverage is when you pay a relatively small amount called a premium to control a much larger value in the market. For example, you might pay a premium of 4,750 rupees to control a contract value of 8,75,000 rupees. In another case, a premium of 7,500 rupees could give you exposure to that same 8,75,000 rupee value. This allows you to see large percentage gains even if the underlying stock only moves by a small percentage. However, you must remember that leverage is a double-edged sword. While it can boost your gains, it also has downside implications because it can magnify your percentage loss if the price does not move the way you expected. In options, you have a predetermined level of risk, but if the option expires with no value, you will face a total loss of the entire premium you paid. Even though their risks are different, both futures and options are used for the same three main purposes: trading, hedging, and arbitrage. While the reasons for using them are similar, the actual rights and obligations of the people involved are quite different. When we talk about obligations versus rights, a futures contract is like a firm handshake where both the buyer and the seller are obligated to complete the trade. But in an option contract, the buyer has the right to buy or sell without being forced to do so. The seller, however, is the one with the obligation. They must fulfill the trade if the buyer chooses to exercise their option. This difference also shows up in the initial payment required to enter a deal. In a futures contract, both the buyer and the seller must pay an initial margin as decided by the exchange. For options, the buyer pays a price known as a premium directly to the seller. The seller then needs to deposit an initial margin with the exchange to ensure they can meet their obligations. The potential for gains and losses is another major area where they differ. In futures, both the buyer and the seller face a situation where gains or losses can be potentially unlimited. In options, the buyer's loss is limited to the premium they already paid, while their gains can be unlimited. For the option seller, the gain is limited to the premium they received, but they could face unlimited losses if the market moves against them. Finally, we have to look at how these contracts are managed day to day through a process called mark-to-market. In the futures market, both the buyer and the seller are subject to the payment or receipt of these margins on a daily basis. For options, only the seller is subject to these daily mark-to-market margins, while the buyer does not have this daily requirement.